Hi, this is Jim Welsh from macrotides.com. Thanks for tuning in. On July 25th, Mario Draghi and the European Central Bank met, and their conclusion was that a significant degree of monetary stimulus continues to be necessary to ensure that financial conditions remain very favorable and support the euro area expansion. Bottom line, what this means is they're going to add more stimulus. We'll find out the details later. The justification for this move for easier monetary accommodation is because the ECB expects slower growth in the second and third quarters, primarily due to weakness in international trade. So let's take a look at what's going on in the euro area and determine whether or not additional easing will make much of a difference. One of the key things to realize is that in this area of the trade dispute, exports as a percent of GDP in the European Union are greater than 45% of GDP, as opposed to the United States, where it's about 12%. This is why the Eurozone has been more affected by the trade dispute than the U.S. More importantly, as we know, the manufacturing sector in the U.S. has also slowed down, but in Germany, the slowdown has been more pronounced, and it's had a greater impact on the German economy. Main reason? Manufacturing is almost 22% of German GDP, whereas in the U.S. it's only 11%. Recently, the German PMI came in and it dropped to 43, the lowest in 7 years. But here is a silver lining amid all this negativity. The service sector, which represents 3 times the size in terms of GDP within the German economy, as we can see, it remains remarkably stable, irrespective of the big and sharp slowdown we've seen in manufacturing. And the same thing holds true for the Eurozone in total. As you can see, manufacturing has dropped very significantly in the last 6 to 12 months, but services continue to hold up relatively well. Since services are 3 times what manufacturing is, it bodes that a degree of stability should continue within the Eurozone economy. Here's a cloud on the horizon, though. Due to the slowdown that has already taken place, and what's happening, if you will, the uncertainty with trade and so forth, banks have started to increase their lending standards. As you can see, so far the increase is very modest, but we want to see if it continues in the months ahead. So far, bank lending to corporations continues to grow at about 4% or so. Nothing great, but the slowdown hasn't happened quite yet. One of the things I think is always important, from an asset allocation standpoint, investors like to have a diversified portfolio. One of the areas they're going to invest in is Europe. But what this chart shows is the relative strength of EFA to the S&P 500. And what you can see is after a period of stability, last May, that relative strength broke down prior to the breakdown in the chart that took place in June of last year. It then stabilized from the period of September going up until the last month or so before breaking down again. So what this indicates is over time, Europe continues to underperform the U.S. And quite honestly, there's nothing on the horizon that suggests that's going to change. Yes, the ECB is going to ease monetary policy. How much of an impact will it have on the real economy? I think it'll be negligible. As we know, bond yields are well below 0% in much of the European Union. The main problem is that many governments have not moved to change labor laws and reduce the overall burden of regulation. These are 2 things that the ECB can't directly affect, and obviously the trade uncertainty is going to linger. So, Mario's going to ease policy. I don't think it's going to make that much of a difference. Thanks for tuning in. Hope something good happens for you today.